Hey everyone, welcome back. Today we're doing something really exciting. We are putting Nabors Industries through the ultimate investing gauntlet. In this explainer, we're putting on our expert investment analyst hats, and we're going to evaluate this company using the exact battle-tested frameworks of legendary investors right alongside some modern quantitative models. We are distilling a full stock analysis straight down to the raw data. So, here's the multi-million-dollar question for us today. Would legends like Warren Buffett, Peter Lynch, or Benjamin Graham actually buy Nabors Industries right now? We're going to take the raw financial data straight from our source materials and process it through their highly distinct methodologies. Is Nabors going to emerge as a hidden gem, or is it just a classic value trap? To get to the bottom of this, here is our game plan. We'll grab a quick company snapshot, run the numbers through the Buffett, Lynch, and Graham lenses, build out some DCF valuation models, and then bring it all together for our master verdict. All right, let's jump right into section 1, our NBR company snapshot, where we set our baseline. Here are the key puzzle pieces directly from the source data. We're looking at ticker NBR, currently trading right around $101 a share, with 16 million shares outstanding. What really jumps out here is that massive trailing cash flow, over $45 a share, all while the book value sits at about $35. Keep these baseline numbers in your back pocket because we're going to need them for the math ahead. Now, you might just think of Nabors as an old-school, asset-heavy land driller. And honestly, historically it is, but here's the twist. They are aggressively pivoting. They're transforming into a really tech-forward platform, pouring resources into automated drilling, geothermal energy, and a high-tech SaaS solution called RigCloud. Moving on to Section 2, the Warren Buffett lens, focusing on moats, management, and margins. Looking at this business through Buffett's eyes, it's literally a tale of two companies. On one side, you have this beautiful textbook economic moat. Their smart rigs command a massive 38% global market share. Plus, that RigCloud software, it's basically a monopoly for integrated rig data, raking in $120 million in annual recurring revenue with gross margins over 65%. That is classic Buffett. But then there's the elephant in the room, a brutal $1.1 billion net debt load from their capital-intensive legacy units. That's a huge, flashing red flag for the Oracle of Omaha. But wait, how are they handling that massive debt? Well, Buffett loves owner earnings, the real, tangible cash a business spits out. And at $45.04 in per-share operating cash flow over the trailing 12 months, Nabors is an absolute cash machine. It's a great reminder that sometimes those boring legacy physical assets act as the heavy-lifting cash cows you need to service massive debt and fund all the shiny new tech. So, what's the final Buffett verdict? Assuming honest management, it's going to be a hold. That automation moat is incredibly strong, no doubt about it. But the sheer weight of that debt, combined with the cyclical nature of the drilling industry, it just doesn't pass Buffett's strict margin of safety rules at the current price. For him to actually pull the trigger, he'd probably want to see the stock drop significantly, maybe down to the $80 range just to bake in a cushion against that debt. Next up is Section 3, the Peter Lynch lens, where we categorize the play. Lynch loved to put companies into distinct buckets, and Nabors fits perfectly as a cyclical turnaround. Now, revenue growth is looking pretty modest, forecasted at just 4.7% for 2026. And normally, that 82% institutional ownership would make Lynch run for the hills, because he loved those hidden, under-the-radar stocks. But listen to this last piece of data. On June 2nd, 5 different directors, Kutz, Lin, Tudor, Chase, and Crane, bought the exact same amount of shares on the exact same day. That is a massive, coordinated wave of insider buying. And for Lynch, that kind of action changes everything. Calculating a clean PEG ratio is kind of messy here, with the company shifting from negative to positive forward EPS estimates. So Lynch would look right at those insiders putting their own hard-earned cash on the line. As the old saying goes, insiders might sell for a dozen reasons, but they only buy for one. They think the price is going up. So strictly as a turnaround play, this signals a confident buy to hold for Peter Lynch. All right, let's bring in the heavy math. Section 4, the Benjamin Graham lens and his defensive investor checklist. Graham was the undisputed father of value investing, and he was all about the raw numbers. So let's plug our baseline stats straight into his famous intrinsic value formula. We're going to take the square root of 22.5, multiply it by the trailing EPS of $12.77, and then multiply that by the book value per share of $35.65. And would you look at that? The formula spits out exactly $101.20. Keep in mind the stock is currently trading at $101.63. I mean, it is shockingly close to fair value. The market has this thing priced almost perfectly on a historical basis. But here's the catch. Fair value was never enough for Benjamin Graham. This is a crucial lesson for defensive investors. Just because a stock trades at fair value doesn't mean it's a safe buy. Graham demanded a margin of safety, usually around a 30% cushion, just in case his math was wrong or the market tanked. With literally zero margin of safety right now, the Graham verdict is a strict hold. He wouldn't even touch the stock until it dropped down closer to the $70 neighborhood. Let's step out of the history books for a minute. Section 5, DC Valuation and Models, bringing in modern quantitative analysis. Since our source data projects $89.5 million in 2026 free cash flow, we can build out a solid base case discounted cash flow model. To do this, we applied an industry standard 10% weighted average cost of capital, which accounts for the obvious risks in the energy and drilling sector, along with a perpetual terminal growth rate of 2%. We're also factoring in their trailing PE ratio, which sits remarkably low right now at just 7.99. Now check out this sensitivity table. By running different discount rates against various terminal growth rates, we get a nice range of potential values. If you look right in the middle at our base case, that 10% WACC and 2% growth, it gives us a fair value right around $95 per share. So again, slightly below where it's trading today. But if we pivot over to a comparable PE multiple model, the story gets a little more interesting. At a trailing PE of basically 8, Nabors screens as highly discounted compared to the broader market. If Wall Street decides to re-rate this stock closer to a normal industry multiple, say 10 or 11, it suddenly implies a fair value range between $105 and $120. So there is absolutely some potential upside there. Which brings us to the most important part of the explainer. Section 6, Synthesis and Final Recommendation. The Master Verdict. So what does this all mean when we put the pieces together? Here are all our fair values stacked side by side. Notice how heavily that mid-90s to low 100s range is reinforced across almost every single framework. Graham's formula says $101, the DCF says 95, and the current price is right at 101.63. Honestly, the market has priced this stock incredibly efficiently. To get a hard buy signal from our gurus, we'd really need a dip. Graham wants $70, the DCF suggests 75 for safety, and Buffett would probably step in around 80. To sum it all up, the bull case here is really compelling. You've got massive insider buying, that expanding high-margin rig cloud software moat, and some seriously strong cash flows. But the bear case is just as heavy. Absolutely no margin of safety right now, obvious cyclical vulnerabilities, and a terrifying $1.1 billion debt load. So, blending all of these expert lenses together, our final recommendation is a definitive hold. At current levels, the risks and rewards are just perfectly balanced. Before we wrap up, I want to leave you with this final thought to ponder. We just analyzed Nabors heavily based on its current reality as a legacy driller. But if they actually pull off this high-stakes pivot into deep geothermal drilling, hydrogen injection, and full AI autonomy, will looking strictly at those old-school drilling numbers cause us to completely miss the real growth story? It's a fascinating question. Thanks for joining me for this explainer. Keep digging into those numbers, and I'll catch you next time.